of it at 6. If it goes up from 6 to 12, that's another double, which is actually a 300% move on your original entry of 3. So, at that point at 12, you'd sell another quarter of your original position, half of your half, and you'd still be left with a quarter. You'd follow through to the ending point, like we just showed you on the last example, how to follow that trend through until it finally ends. Well, what about the bearish case? The market's been more bearish in late July and August so far. And what we're looking at here is an example with Bear Stearns, BSC. Ironically called Bear Stearns. They've had some problems with hedge fund blow-ups, and the major brokerage has been under a lot of pressure, as the whole brokerage sector has. And you can see here, we had a lot of attempted setups below this minus 80 threshold, but a lot of these moves under the minus 80 threshold would never confirm. We'd get attempted breakdowns, you can see, then they'd bounce right back. So these bounce backs, we don't get confirmation until we get this final one here that happens down to just under $140, about $136, and then 2 bars later, at about $130, it's confirmed. We close underneath that low. So that's the first confirmation here. We call that bear confirmation. Okay, and let's say you miss that. You get the first wave down. We've all been in that situation where you miss a move. But how do you get back on once you've got an established, confirmed, in this case, downtrend? Once I've got a confirmed trend, in this case, down, we get this couple of bars bounce back up. This bar here on the 30th of July, you see that the percent R goes back above the oversold threshold, back above this lower blue boundary. Well, and like I said, in the past, I used to close out, but in fact, that's a great low-risk re-entry point. Well, I'll be adding the next morning after I see that and run my nightly scans in the MetaStock platform. I'll be seeing that and then putting it on the next morning. You say, well, it opens above your high of the 30th. Does that worry you? No. I've learned that you've got to follow this through to the end of the day, and these kind of reversals more than make up. When we get this big, great entry point here, back about $130, and then boom, you're at $100 in about 6 trading days, that you have a situation here in which you really are very happy to take the few points of risk, or even if it was 5 points of risk. Bottom line is you make 30 points on the downside. Risk reward, I'm looking 5 or 6 times or maybe more, depending on what my closing stop risk would have been above this about $128 level here from August 30th. So that's just another good example. Well, here's our next retest that happens. You've already gotten a chance to take a double on half. Remember, if we're buying in the money options with a stock at 128, we're looking at the 130 puts, or I was actually into the 135 puts, a little more in the money, a little more conservative, but getting rid of a lot of the time risk in case it flattened out. So in this case it doesn't, and you see where we then get another retest right on this dotted line on August 6th. That high now, just under 115, should have held, and we should have seen it on a good trend go back down. We've already taken half out of the double. We're just following the indicator through, and then boom, it snaps back up and closes above there, back at about $117.50. So you've got to stop out there when you see that happen, or if you don't see it there, then get out and the next bar's open. Back again about $118. So now that's an up arrow saying that's an exit. That is not a buy. That's just the end of the downtrend. So it's saying that's where you're getting out, and now you're just saying, okay, I'm done, and I'm sitting here waiting for my next edge. Don't trade moves in between this 20 and 80 threshold here when we're not confirmed, because there's just too much noise. It's just a trading range. So that's what this is saying at this point, is that's just a trading range now. Not interested in buying or selling until we get our next breakdown or our next breakout, then we'll get the next major opportunity. So that's when you can see on this chart we had a slow downtrend, but if you're buying puts through the slow downtrend, you may not getting paid off because you're losing time there. You need the downtrend to be fast enough. You see the acceleration to the downside, and that's what really helps you to pick that up when we combine that, and I'll show you some combined charts here in a minute. Now, I wanted to also share with you another unique indicator I developed that is now available in the MetaStock platform in the Big Trends Toolkit add-on. That's the concept of efficiency. That when we're in a trend, we want the most efficient price action possible. As an example, if I told you you could buy, not just buy a bullish position, but let's actually talk about buying a call position. If we buy a bullish call position in the options market on either a volatile, say, tech stock in red that you know is going to be more volatile, but you know it's going to go from a lower point A to a higher point B, and I compare that to, say, a less volatile stock, say that's kind of just slowly chugging along, but is also going from the same point A to the same point B, I always ask people in seminars how many people would want to buy the slow chugging along stock in point A on call options on the white stock in point A versus the red, more volatile stock here, going from point A to point B in both cases, I should say. So, the red, let's say red's twice as volatile as white. Well, you get the same directional move. The options market knows that this tech stock is more volatile than, say, some utility stock or some other slow-moving sector and stock. But the point is that it's trending, and the options market prices for volatility, not for trends. So you're paying twice as much for the volatility of red. So which one's going to give you more than give you twice the return? The white options you pay half as much for are going to give you twice the return for the same directional move, just going from point A to point B. Now, some people will say, well, I want to buy red because I'll get in here, get out here, get in here, get out here, get in at the bottom, get out at the next pop up. So, if you can do that, obviously, consistently, then more power to you. But, what I find is that as a trend trader, for me, the more noise that's into a trend, the more it's going to risk whipsawing me out, stopping me out into these pullbacks, because it just looks like, oh boy, it's breaking down, and then it flips back up just because it's noisy. And so that's what my indicators are designed to do, is find these steadier, more predictable trends that will allow you to sleep better at night, as well as have actually a better bang for your buck in the options market, because they're not pricing for the trend, they're just pricing for volatility. So that's a big, big difference that you need to know about, and that's what I factor in with the concept of efficiency. I want these efficient trends that don't have a lot of fallbacks along the way. Well, we talked about American Home earlier, and now we start to combine indicators. We've got the percent R here in the top third of the chart, the efficiency ratio in the middle third, and then American Home we've got in the bottom third with the acceleration bands. Now, this is in MetaStock, and so now you can start to overlay these concepts on top of each other. I don't want to look at too many things at once, but I find usually looking at up to 3 panels is about right. 2 or 3 panels, you don't need to overload yourself. But these are some of my favorite indicators, and we have more. But the idea is that depending on what time frame you're trading, this is ideal for a swing trader on a daily chart here. So we're looking at a situation here in which we get first kind of break to the bottom bands on AHM, but we don't break down. You can see that percent R tries to break down, doesn't fall through below that low, so that signal is not valid. Also, the efficiency ratio, notice this lower blue boundary on the efficiency ratio is actually at the minus 30 level. That at minus 30 is where I usually see things really kick in as a very negative efficiency if we get follow through. Notice percent R breaks down and the accelerations break down back here just under $30. The efficiency ratio confirms that also in the next bar at about $28 here, and you're still on your way from 28 down to about 21 on this move down in the stock of AHM on that first leg down. Notice in contrast, I was showing you earlier how it looked like the acceleration bands got faked out. We broke below them for a couple of bars, but notice the percent R was only just breaking down right here, and the efficiency hadn't even broken down at all. So we actually would not have these indicators all coming into unison like we would like. And same thing, you can see percent R tries to break down here, but we're not below the lower bands, and efficiency is not below minus 30. So this didn't quite happen as a new signal here either. But then look at the breakdown. All 3 break down at once here at the end of June as the stock gaps down. We get the efficiency back under minus 30. Percent R also below minus 30. When I was looking for confirmation, we see that confirmation happen about 5 bars later right here, right before the big acceleration to the downside. Notice we don't quite get the retest back to the minus 80 threshold. We come real close right on this bar right here. Efficiency is very, very weak. It gets to about minus 80. Almost minus 90 really right there, and so that's a very strong downtrend as long as efficiency stays under minus 30. So that's a situation in which staying under minus 30 then confirmed, very powerful to the downside. Contrast that. Let's look at a bull example too, just to show you how a bull example would work. This is Crocs, the shoemaker, CROX. A lot of people have called this a very fad-oriented stock. They make these plastic sandals and other types of shoes, kind of beachwear and other stuff. But I've got a pair. I love them. Bottom line though is that it doesn't really matter whether you love the product or not. What matters is how are the indicators setting up. When you see, I've got this blue vertical line drawn because we've got not only the breakout above the acceleration bands and the percent R breaking out, but then also the efficiency ratio is broken out too above the plus 30 threshold, this upper blue boundary here. I've now got efficiency on the upper scale, just right up here. But bottom line is that we've got them all now in alignment, and then confirm the very next bar here, a couple bars after April 9th right here. The stock was just under $30, and you see it edging up. It's back into the acceleration bands, but we're holding the percent R retest level. Also, we get a retest back to the plus 30 level on efficiency right off of this low. So real nice kind of double retest right in here, right off of that low. And I love those retests to get back on board or to tighten my stops. And then boom, the stock comes out with earnings a couple weeks later, and it takes off to the races. We're breaking out, breaking out. Look at how long this thing stays overbought. And we don't actually get a retest until both of these come slamming down under the plus 30 efficiency and under the minus 20 overbought percent R level right on this retest. And we actually told option chart clients, even though we're back into the bands, we're right near the lower